p.m. again, so it's time for 55 minutes of business, going around the world of business here on Business Incorporated. Here's what's coming your way in the next 55 minutes. Good news for Egypt as unemployment drops to 6.9%. As we speak, the MPC meeting is going on in Kenya and they are set to hold rate. Not a very good one for Nigerian electricity consumers because the federal government has hiked the rates, the tariff of electricity. Good afternoon. Welcome to Business Incorporated. I'm Ini John McQuarrie. We started from the global space, as usual, telling you what's going on with especially oil prices. Prices steadied on Wednesday as investors eyed concerns around crude and fuel supplies following Ukrainian attacks on Russian refineries and the potential for a widening of the Israel-Hamas war to more directly include Iran. Brent crude futures for June rose 4 cents to $88.98 a barrel, while WTI for United States for May dipped 4 cents, $85.11 a barrel. Both Brent and WTI climbed 1.7% during the previous session to their highest since October. Prices surged after a Ukrainian drone attack on another Russian refinery threatened to take even more of the country's processing capacity offline, curbing output of the gasoline and diesel fuel. Russia is among the top 3 global oil producers and one of the largest exporters of oil products. Investors are also concerned that Iranian retaliation against Israel for an attack on Monday that killed high-ranking military personnel could potentially lead to supply disruptions in the key Middle East producing region after it vowed revenge. Iran, who provides support to the Hamas militia fighting in Israel in Gaza, is the 3rd largest producer in the Organization of Petroleum Exporting Countries. Well, still in the global space now, but for metals, gold prices extended a record run on Wednesday as concerns of rising inflation boosted demand for gold as a hedge, with bullion traders shrugging off debts. Doubts over an imminent U.S. interest rate cut and rising treasury yields. Spot gold was up 0.3% at $2,286.24 per ounce and hit a record high of $2,288.09 earlier in the session. Bullion has hit record highs consecutively since Thursday last week. U.S. gold futures gained 1.1% to $2,306.60. Elsewhere, spot silver rose 1.2% to $26.41 per ounce. Platinum was also up 0.8% to $925.92, and palladium edged up 0.6% to $1,009.45. In the grain space now, Ivory Coast has agreed to pay cocoa farmers more for their beans, heeding calls for a price hike after futures surged to more than $10,000 a ton. And the world's top producer of chocolate ingredients will disburse 1,500 cefas a kilogram for the mid-crop harvest that runs to September 30th. Ivory Coast Agriculture Minister said that in Abidjan, a move equal to 50 pieces increase on the payment for the main crop season has just ended. In Nigeria, the Central Bank of Nigeria has increased foreign exchange rate for customs duty clearance at the country's seaport by 2.1%. This comes a few days after the financial market regulator sustained the cuts in the customs exchange duty rate, which it had announced earlier. According to information obtained from the official trade portal of the Nigeria Customs Service, the FX duty rate was reviewed upward from 1,303 naira 80 kobo to the dollar to 1,330 naira 26 kobo on Tuesday, the 2nd of April. Meanwhile, a total of 1.3 trillion naira worth of revenue has been generated by the Nigeria Customs Service in the first quarter of this year, 2024. The Controller General of Customs Service, Mr. Bashir Adewale, explains that over 572 seizures were made with a duty-paid value of 10 billion naira and an arrest of 22 persons. Mr. Adewale says that a total of 1.6 billion naira was generated through its electronic auction platform launched in the first quarter of this year. The customs boss, however, says its major challenge is the fluctuations in the exchange rate regime, which it says has disrupted a lot of activities. And now to some good news. Dangote Petroleum Refinery has commenced the sale of automotive gas oil, which is known more as diesel, to local marketers nationwide. The Dangote Group executive, Mr. Edwin, confirmed that products are being evacuated by sea and road as local oil marketers agreed to pay 1,225 naira for the product, according to the Borg purchase agreement. It can be recalled that on January the 12th, 2024, Dangote Refinery announced that it had commenced the production of automotive oil, popularly known as diesel, and aviation fuel, which is Jet A1. And we'll discuss on how important this is, or some of the impacts that we expect from this, with Dr. Wisdom Enang. He is an oil and gas expert, and he joins us in the studio. Dr. Wisdom, good afternoon. Thank you for your time.
Good afternoon. Thank you very much.
So we have this, I believe, is good news from every front, because this is energy security for the country. And more importantly, we see that that's Dangote is being strategic and looking at the industrial arm first, because when you talk of diesel, you're talking of big factories and then the articulated vehicles that take a lot of logistics. And then when you talk of Jet A1 fuel, you're talking of the aviation sector.
Yeah, very fantastic. And, you know, for me, I'm really going to thank the Dangote team for what they've done. First and foremost, I think a number of things they've had to solve to get us to this point. We've had to, against all odds, get through to the completion of the refinery as promised. We've also had to scale through the regulatory hurdle that, borders on the distribution of these products for us to get here. And the other thing is that we've also had to do strategic sourcing of crude. I mean, the Dangote refinery has had to go all the way even to the US to get partnerships on crude, just so that if we don't get the sort of quantities we need in country, we can have a guaranteed supply from those sources. So that's very good. And even the products themselves, they're going to stimulate the economy very, very much, because we're now having cheaper AGO products. And what that means...
Is it cheaper? It's going to be cheaper.
Yeah, I mean,
because you still have the logistics cost. He's still importing crude.
Yeah.
You know, so are we going to, should we expect a drop in the price?
I mean, so let's just superimpose the macroeconomic factors we have at the moment. The fact that we're also expecting some improved macroeconomic outlook. For example, the exchange rate, we're expecting it to come even further down because, of course, more FDIs are coming in. We've got the increased basis point on the interest rate. That means that the naira is more attractive to save at the moment than some currencies. So if we superimpose that, and the fact that we're also trying to increase our internal production of crude, there's that mandate, of course. So if we superimpose that with the price that has been set today for off-takers, 1,225 per litre, and we're hoping for things to get better, then of course we can, be assured that the price will be better. And what are we comparing against? We're comparing against 1,700, which is what people buy at the moment. So I don't expect it, all that taken into consideration, because remember, the supply situation was actually the problem. When it comes to the logistics and storage value chain, that is already established. So we already know the sort of margins that we would add to our off-take price to sort of get. So I don't expect it to go beyond 1,500. If we really, and the truth is this, right? Getting to that price is also going to be anchored on the honesty of those distributors, because, I mean, if you're taking it off at, say, 1,225, you need to be honest. And the unions that, sort of put themselves together, the marketing unions, need to enforce this, that, of course, at the end of the day, someone is not going to take it at 1,225 and then end up selling at still 1,700. So
yes, that's what I even wanted to say, because it's one... And I think it's a strategy for Dangote to make public the cost.
Correct.
1,225 naira. So, I mean, whatever price you see from your retailers, it's not from our end.
Correct.
But there has to be I know we have regulators at different points, but I think somebody has to follow up to ensure that some people don't get greedy.
I think, the regulators have to follow up. I think that's the more apparent answer. But I'd like to just put forward a method that I think will work, and I'll call it the DDD. I'll call it, we've done the discussion, then the documentation, and then the disclosure, discussion, and documentation. So, of course, they've disclosed the price point that they're taking. That should then feed into an agreement to say, okay, because you've taken at this point, factoring all this is what we expect you to sell, and then you then document, the people that are actually, be engaged in this program. So, for example, from the off-takers to then people that then, the retailers that get from those off-takers, I think those sort of disclosure would allow the consumers have an idea of where they can get that on the supply value chain, and will also help to make sure that those guys are guided to know that the public is watching. Basically, you've taken a much more affordable source of AGO, and we do expect you to pass that on to the consumers.
And we do hope it works that way, because this morning we had a conversation with the manufacturer, and he drew our attention to the activities of the non-state players. So these are individuals who add to the costs of products, especially when it has to do with movement on the road, but they are not officially recognized. So we hope that this will not be another food for the non-states. You know what I mean? Because you see them on the road with the sticks, harassing especially articulated vehicles. And we do hope that the government can actually do something about this.
I think ultimately the government will take a driving seat on this one. But, at the end of the day, we need to have this patriotic sort of behavior on making things work. We've seen Dangote come out, and I just have to, say another word of gratitude, because my biggest fear was when they start production, would they be tempted to supply the regional market ahead of the Nigerian market, because of it may make some commercial sense, especially for PMS. But I'm excited to learn that he's taking that initiative to make sure that all the three tenets of energy security, accessibility, affordability, and availability is being put together through this refinery. And I think all of us Nigerians need to also take a part in making sure that, yes, wherever you are on the value chain, that you participate to make this a huge success, because it's not just a success for the Dangote Group, it's a success for Nigeria, and it's actually a precedent, really, because the reason I'm saying this is it's a precedent for when we begin to run the PMS on a market-driven, situation, that we're not just, right now we're having a floating, what I'll call a price peg situation. So the subsidy is out, but we're also pegging the price so that we can protect consumers from the effect of the, increase in price from PMS, right? But when we eventually pull out that price peg and allow it to be market-driven, we need to have the supply and the demand having to determine the price. And whatever happens from then on in the Dangote, this particular initial phase of supply, is going to determine what ultimately, and the lessons learned, the experience, and what we do take on board when we eventually replicate that for the PMS.
Okay, so now, paint a picture for us. What can we expect? Even in the aviation industry, everybody would expect a drop in the price of tickets, but I know it's a long, very long circle. But what can we expect now that Dangote is now supplying to the domestic market? Everybody's hoping for energy security, at least for the factories. Can we expect it to trickle down to prices of commodities and increase PMI for the country without boosting production?
Yeah, I think there are a number of things that are working in tandem to give us the sort of, outcome that you're looking at. The first is the fact that even if you go to your shops or your suppliers, you'll find that there are some products that you used to have which are not there anymore, and most of them were imported. So at the moment, we're now having, first, there is a need to fill up that gap, because consumers are coming for these products, they need alternatives, and so that is one thing that's working in favor. The second thing is, once you start dropping the prices of production through the drop in the price of the fuel that is used for this production. Those two factors will work in tandem to facilitate a more, increased production outlook from the manufacturer. So we are hoping that that would stimulate the market more positively, add to our GDP, because at the moment, you see, some of the inflation drivers is we're having a lot of money in circulation, but then productivity is not matching productivity. And so we hope that that will stimulate, and I think that's a very ample opportunity. From the aviation sector, what we would expect is that cheaper prices of fuel, but of course it's not the effect of this is not going to happen overnight, right? We're going to have about 2-3 months of lag before we start seeing this attendant effect. Remember, a lot of these aviation companies may also have bought in bulk and done strategic storage. So at the moment, you would find out that they would need to run out of their inventory before they start taking advantage of this new pricing. And we hope that we are able to have enough supply that of the feedstock to the Dangote refinery that we do not have. They started out well, but then the market dynamics doesn't allow them to continue with favorable prices for the Nigerian consumers.
All right, we certainly do hope so. I guess that is why Dangote wisely decided to have alternative supply of crude, so there'll be no gap. But thank you so much, Dr. Wisdom Enanga, oil and gas experts, for your time.
Thank you very much.
All right, and just before we started off the program, there was a breaking news that came in saying that the federal government has increased the tariff rate to 225 kilowatts per hour and is applicable to Band A customers. Band A customers are those serviced with 10 to 20 hours a day of power. Let's understand this more. Professor Yemi Oke joins us virtually now. He's an energy expert with the University of Lagos. Professor Oke, good afternoon. I don't know if to say good afternoon with this increase, because Nigerians are already squeezed on many sides, and this is another squeeze added to the existing ones. Hello, Professor Oke. I cannot hear you. I don't know.
Thank you very much.
Okay, I can hear you now. Can you hear me?
Now?
Hello?
I can hear you.
Okay, I can hear you now. Please go ahead.
I can hear you now. Okay. I want to say that Nigerians are taxed needlessly with the just recently announced increase in tariff. What we need to understand is that this is targeted at increase in production. It's going to be cheaper at the end of the day for the categories that is targeted now, because those are high income earners and commercial sector that tend to consume more, and they are glamored for the fact that they are willing to pay slightly more if they have the supply. So this is now a question of demand and supply. On the one hand, talking about the business side of it. Two, there's no way generation by conventional distribution structure will be expensive compared to diesel and other alternatives. So what the government is trying to do, technically, is to pull back a kind of similarly wasteful subsidy regime and plow it to encourage increase in production, particularly from the gencos. And that will also stimulate the sector for us to have increase in power sector investment, which I haven't had in a couple of years. So looking at it from the viewpoint of technicality and sector reality, an average Nigerian user or consumer of electricity is willing to pay slightly more provided they have access. And that is what we are looking at in this scenario, meaning those who have been enjoying 10 to 20 hours can now enjoy between 15 to 24 hours, and the hours they subscribe to alternative sources of diesel and embedded, which is quite expensive, will not be readily available to them cumulatively, power will now be cheaper if it's available.
All right, Prof, but doesn't that mean...
Because the alternative is to go right. Yes, please, I'm with you.
Doesn't that mean that the rich will get richer and the poor will get poorer? I mean, because I don't think this automatically means that generation will increase. Perhaps that's what it means. Please correct me. But if we say everybody is happy with, if you were doing...
No. I'm with you, but I think that...
So, Professor K, I was asking, doesn't this mean that the rich will get richer, this time for energy supply, electricity supply?
Ultimately.
And the poor will get poorer, because those who have been enjoying most of the hours, which is 10 to 20 hours, will now be enjoying about 15 to 30 hours. Doesn't that deprive those who have been enjoying a couple of hours, you know, taking a little that they had?
Definitely no. What it simply means is that investors will be encouraged to come in, and then we'll also have to explore alternatives. Then government will also...
Wow, sounds like...
Government will have to look at it as it, because Nigerians can now take charge and regulate their consumption pattern. If you wish to be on 2 hours consumption, you know you can afford 2 hours of stable electricity. You're going to patronize appropriate disco for the 2 hours of consumption you're going to have. And you are not able to do that if you don't regulate your consumption. That is why presidential metering initiative is key. Meaning government can now focus on appropriate metering so that Nigerians will pay for actual electricity that is consumed. Because I've always argued that it is criminal to pay for electricity that you have not consumed. Meaning investors can now target strategic sectors, because state governments are going to come on board. Gradually, they free up the space. You know, it's a question of demand and supply. If you have 4,000 megawatts to ration in a country of about 200 million plus, it's not going to drive us anywhere, because that is the kind of amount of megawatts we've been kind of rationing since privatization. That was similar to what we had under the whole NEPA and PSCN. So we haven't really had aggregate increase in generation, which will have enabled discos to have more to distribute to consumers. So the industry is trying to amass megawatts. Average homes and offices are also trying to amass megawatts. And the government is saying, oh, you production sector, you should have more. Because if we generate, it's going to stimulate economic development and growth ultimately, as against spending most of their earnings on diesel and other alternatives. So ultimately, it's the...
All right, Professor. Okay, I really wish we could have more conversation on this, but do stay with us here on Business Morning, Business Incorporated. We'll certainly follow up on this conversation to get more understanding. I hope we can get Professor Oke. If not, we'll get someone who would help us to understand some of the implications. But from what Professor Oke is saying, this is obviously having its focus on the industrial sector of the country, the real sector, to give them even more power, because they have indicated that they do not mind paying more. So I think the correct thing is not between 10 to 20 hours, is minimum of 20 hours. So those who have been enjoying minimum of 20 hours are the ones affected. They're the ones captured in the band A, and they're the ones who would have to pay more for the electricity, with the option of increasing availability of electricity, which, I mean, if done, is going to boost production in the country and feed into our real sector and our GDP at the end of the day. Professor Oke, thank you so much. Unfortunately, the network will not allow us to complete this conversation, but thank you so much for your time and your explanation. Let's take a break now. FX is back, and they have some messages for us during this break. Welcome back. Still watching Business Incorporated right here on Channels Television. We head to the market now to get, well, intraday after the first day of trading for the quarter. Willie Bong is here. Will, yourself and your guests yesterday were disappointed because the market ended in the red after so much expectation and excitement at intraday.
It was just one of the things that happens in the market. You can't really predict what's going to happen. One flip, one shift, and then every other thing changes as well. So let's just say it was not unexpected. It's expected.
There you go.
there you go.
Market analysis. Analytics.
Yes, the analytics. So today, yes, it's not. The markets are all, for major equities, we're seeing blood right now. So we just hope that by the close of trade, we'll have something different.
I don't hope with you. I choose to be realistic.
Okay. So we begin with major equities in Africa. As I mentioned, they were negative at intraday. Nigeria's NGX was down at intraday. We see that on the screen. We just wait for that to pop up. Yes, that's it. 0.05% at intraday. Still at 204,000 points, and we see South Africa also in the red, down more than 0.5%, 0.57 to be precise. And elsewhere, Egypt's EGX is also down at intraday. 0.81% is bloody for these indexes, and while Kenya closed Tuesday session also in the red. So we're just waiting for that pickup. You know, this is the second quarter. I would know, wondering why are they lagging behind. Hope to pick up very quickly. But let's check out what's happening at the fixed income market in Nigeria and see what's happening there. The Debt Management Office has released its FGN bond issuance calendar for the second quarter of 2024, and we have joining us Chuka Nwachukwu, Group Head Asset and Liability Management, to share his thoughts on that. Good afternoon, Chuka. It's good to have you on the program.
Good afternoon, Will.
Chuka, there were some, looking at that bond calendar, there were some new introduction. There was a new introduction and some adjustments made to the range of amount on offer. But I know that it's a lot for people who want to know what's going on there. I could read out the numbers, but we would like to hear it from you. Could you just, break it down for us?
Okay, so the two takeaway from the new calendar, first is the introduction of a 5-year bond, April 2029. Then secondly is that the volume, we're not seeing the trillion volume on offer. So what we've seen is that we've seen about 600 billion will be offered. So what that means is that whilst the DMO is aggressively looking to meet up his obligations, they're also making it, keeping it within the range of which the market range. So in that trillion, and of course, like I said earlier, the 2029 bond, which is reintroduced in the market.
Okay, so we also, still speaking about the 2029 paper, we know that the 2031 and 2034 bonds were reopened, and that's the 7-year and the 10-year maturities. They all have interest rate, both of them 18.5% and 19% levels. But what are the rate expectations for this new 5-year bond? What are we expecting here?
So if you see the 2026, 2027, and 2028 bonds, both all printed around between 20.5 to 21 basis points. So we expect to see this 2031, especially 2034, to print within that same range around 20.1, 22 basis point, percent levels. And so it's one of the attractive bonds, and this period is actually quite attractive for investors when you see yield elevated to this level. But basically what government is saying that, look, we need foreign investors to come in. We have attractive investment opportunity, especially on the fixed income side. And then you bring in your dollars, and then we give you attractive yield. And so 34 is, it should be within that 2021 levels, and, it's quite attractive for investors.
Oh, that's really fantastic. So would want to know what investors are trading as we speak. What end of the curve are they playing? How many have we sold?
Well, funny enough, the market has been very active. If you say the 1-year paper, for example, which printed around 21.12, It's currently trading around 18.5-19 levels, and that shows interest in that particular paper. So, and across all board, we've seen quite activity in all the maturities, and so markets is currently trading flat, indicating that there's quite a lot of activities all across board and all across maturities. And so for today, for example, what has slowed down the trading activity is the issuance of the OMO. We saw about 600 billion being offered in the market today, and so that has actually reduced activity. Investors and players in the market are waiting for the result of the OMO. But for now, our market is pretty quiet and active as well.
Thank you so much, Chukwuemeka, Group Head, Assets and Liabilities Management, for sharing your thoughts and insights on Business Incorporated. It's always good to have you.
Thank you, Will. Thank you.
So we'll move on to the Middle East now, where major equities, that's most major equities in that region, traded negative at intraday. Abu Dhabi down 0.03%. We see that on the screen there. We see Dubai also down 0.08%. Still within the region, we see Saudi, the only gainer, that's the lone gainer in that region, 0.72% up, and the Qatari index down 0.76%. This index is trading in opposite directions. Now, the Qatar Stock Exchange on Tuesday lost about 70 points on profit-taking pressure, and this especially in the banking and financial services sector. Also, we've seen reports coming in that shows that the total market capitalization of the Saudi Stock Exchange rose 9.56% year-on-year to 10.94 trillion Saudi riyal, and that's about $2.92 trillion by the end of the first quarter of 2024. And we see Saudi's Tadawul, that's the index, the all-share index, reached its peak, closing at 12,835 points on March the 21st this year. So we move over to the U.S., where stock futures, they were little changed in early trade today after the Dow Jones Industrial Average fell for a second day in a rough start to the quarter. We've seen that futures index down 1% to 39,000 points, and we've seen the S&P 500 futures down 0.71%. NASDAQ 100 futures dipped nearly 1%. Wall Street is coming off a losing session for the major benchmarks after sticky inflation data from last week, as well as some strong economic data, had investors concerned that the Federal Reserve will take longer to cut interest rates. Will stock markets tumble to a major pullback? While we'll ruminate on that, let's check out yesterday's close with our correspondent, Maria Bird.
On Thursday, the U.S. stock market was mixed, as the Dow Jones and S&P 500 were both up at 0.1%. The heavy tech NASDAQ was slightly down at 0.1%. As Thursday closed out the first quarter of 2024, many investors saw this as a positive sign, as 2024 started off much better than they expected. The S&P 500 even saw greater wins than they were even expecting, and ones they haven't seen since 2019. It is also clear that investors are going to continue to watch the weeks and days ahead, as they will also be watching to see inflation reports that are expected to be released to see if the U.S. economy can withstand over the next few months through the second and third quarter of 2024.
Thanks, Maria. It is safe to say that some market observers remain optimistic. Overall, on equities, they say the stocks are due for some consolidation after a strong start to the year. Now we move to Asia, where stocks fell on Wednesday, tracking declines on Wall Street overnight, with shares of electric vehicle makers dropping on demand worries. Japan's Nikkei 225 was down nearly 1% there. Another day of decline for this index. Now, South Korea's Kospi also dropped 1.68% to 2,706 points. We see that is the Hang Seng is also lower. It's just bloody in that region, 1.22% after rising more than 2% in the previous session. Now, BYD shares fell 2.5% after the Chinese EV maker said its first quarter sales plunged 43% quarter over quarter. Other EV makers also fell, and this is bouncing off losses in Tesla shares as the U.S. EV maker first quarter vehicles deliveries dropped 8.5% from a year earlier. Meanwhile, let's have a look at mainland China. The Shanghai index is also down 0.18%, even as the country's service sector activity expanded at its fastest pace since December In Australia, the ASX 200 is also down, closed 1.3% lower, extending its declines from the previous session. So, Ini, I just got bloody for today. It's more like the blood is running and never wanting to stop. But I hope that tomorrow we have something positive.
Yeah,
see, I'm wearing neutral. It's grey, it's neutral. I'm just in between.
So yeah, morning with the market.
Yes, definitely.
I'm sure investors are listening and they will help.
Please help out.
All right, Will, thank you so much. All right, let's go to Germany, where it seems, I mean, a lot of Germans have been described as hardworking, but it seems they're tired of that, and many do not want to work anymore because they're asking for something that the government is questioning. But Lars Holter joins us now with the details. Hi, Lars. What's going on? Why don't they want to work again?
Thanks for having me, Ini. Well, it all started a few months ago with those train strikes that had been very frustrating for Germans. The train drivers union had demanded that they would get to work a 35-hour work week, make the same and Germany's state-owned rail provider had made it clear that this would be untenable, too expensive, they said, and even worse, they barely have enough staff right now as it is, so cutting people's work week would make it even more difficult to keep the trains running. And yet, after several strikes and long discussions, the union actually got what they wanted. They did get a 35-hour work week written into their contracts, and that has now increased interest in that idea for many others. The idea to work less for the same pay obviously appeals to many, and some companies are happy to oblige because they have realized that in an environment where few people are available for lots of open positions, they will have to do something to make themselves more attractive as employers.
Yeah, but I wonder what this is going to do to the German economy.
Yeah, that's the billion-dollar question, of course. Even those economists who are generally for a shorter work week, for the reasons I've just mentioned, there seems to be one hang-up. They say it can only be done, quote, where it's economically feasible. And while that might be the case for some companies, like I heard of a roofer here in the area who says that they can get their work done in 4 long days and then take Friday off. But it will most certainly not work for an entire nation because it would translate into millions of hours not worked. And that would be a tremendous loss to productivity. And to make up for that, productivity per hour would have to jump. And it hasn't over the past few years. It rather inches up, growing very slowly at around 1% per year. Now, some economists have calculated productivity in Germany to drop by around 5% if we had a 35-hour week. And that again would of course translate into losses in gross domestic product. It's really strange to even discuss this at a time when the German economy isn't doing very well anyway. We've just had a recession and currently we're not seeing much economic growth at all. And again, looking at productivity and the workforce, we're heading into a few really challenging years now. The baby boomers are retiring, and that is an extremely strong generation, and they're replaced by a generation that numbers way fewer people. So fewer people working fewer hours. I really just don't see how this could possibly work.
Yeah, well, it looks like a very hard situation for the government there, especially as you noted, it's still a fragile economy right there that requires a lot of production activities. But let's go to the markets now. How's that looking?
Yeah, there's no shortage in news today, but none of them good. Let's start with yesterday's drop on Wall Street, followed today by some weak quarterly numbers. GM sees its first quarterly sales down in the US, but earnings season, of course, is just beginning. So let's not be too quick to guess what we are seeing here. But shares definitely have climbed to lofty levels recently, and now we'll have to see if that can be backed up by what's really going on in those companies. Asia is down this morning, likely taking a cue from the US here. And then there's also a tsunami warning coming out of Japan after last night's earthquake in Taiwan. So quite a lot to chew on for now.
All right, Lars, thank you so much for that.
Thank you, Ini.
Let's head to Africa now, where Kenya is likely to leave the benchmark interest rate unchanged at a 12-year high. Today, they're still meeting. We're hoping we'll get that resolved by now, but the decision has not been announced yet. And this is giving more time for inflationary pressures to ease before it loosens up on its steepest tightening cycle in more than a decade. Economists expect the Monetary Policy Committee to hold the key rate at 13% and signal the way for cuts if inflation continues to soften. Would remember that the Kenyan shilling has been gaining in the last couple of days, and the inflation we told you about yesterday is now at 5.7%. Well, it seems Malawi is listening to what's going on in Germany, because Malawi's parliament has voted to legalize the cultivation of a local cannabis variety for medicinal and industrial use only. The parliament leader, Richard Chiwendo Banda, is reported to have said that smoking of the highly potent and globally acclaimed strain, locally known as Chamba and Malawi Gold, remains prohibited. Nowhere in the bill is it written that people will be allowed to use this Chamba for recreational purposes. Malawi Gold is the legendary land-raised strain recognized as an international prize, priding itself on its complex flavor profile and intense and industry publication also supports this. Now, Malawi joins a growing list of southern African nations that are legalizing the production of cannabis for medicinal and industrial use. Lesotho was the first in 2017, followed by Zimbabwe and South Africa a year later. Zambia did the same 3 years later. Botswana High Court allowed the company to grow cannabis for industrial and medicinal purposes. That was in 2022, and they hope to benefit from the economic potential of the multi-purpose crop. Well, listen, cannabis is going around the world now. I hope it doesn't get to Nigeria at this rate. I believe we have enough on our hands. So from there, we head to Egypt, where British Steel has won a contract to supply a major new rail route in Egypt. A total of 9,500 tons of track is set to be manufactured in Egypt's Green Line Railway. That's the country's first fully electrified mainland and freight network, stretching from the Red Sea to the Mediterranean. The network is 660 kilometers long and will carry trains for both passengers and goods up to a maximum speed of 250 kilometers per hour. British Steel is among a number of key suppliers providing rail to the project. 2 shipments of rail will be transported from the British Steel to North Egyptian part of Alexandria this month. That's in April, and in June. It will be used to extend the line from Alexandria via El Alamein to Mediterranean coast in the northwest and eastwards to the Gulf of Suez and the Red Sea. The project is being managed by Orascom Construction, an Arab contractors joint venture, with the design, construction and commissioning as well as operation of the line handled by National Authority for Tunnels for Egypt. We're still in Egypt, where a report from the Egypt's Ministry of Manpower and Immigration shows that unemployment declined from 13% in 2014 to 6.9% in 2024 because of giant national projects that provide millions of job opportunities in all fields and also absorb large numbers of irregular workers and integrated them into the labor market after officially being registered with the Ministry of Labor. There are 28,298 irregular workers now working in New Alamein City and 65,261 workers in the new administrative capital. The ministry said in its report that during that period, it contributed with national partner agencies to reducing the unemployment rate, and it was providing employment opportunities at home and abroad through the National Job Bulletin released every 15 days and employment forums in coordination with the private sector. The ministry has employed more than 7 million youths at home and abroad through its various tools and mechanisms for employment in coordination with the private sector and based on the data of permits granted to Egyptian workers. During the same period, the ministry also licensed more than 225 companies to practice recruiting Egyptian workers to work abroad and renewed the license of more than 1,000 207 companies. All right, now let's do crypto business now. The market that never sleeps is where we're going to and see what's going on right there. If we could start with the headlines from the crypto space. We see Bitcoin has recovered from what we saw yesterday, gains bullish momentum. Has it really recovered, or is it just a dead cat bounce? I think that's what they call it. So you just have temporary jump, and then before you know it, your heart gets broken because you don't see that anymore. But it's now at $66,554.50. It's up 0.42%. This is about 12 noon today, but the color looks better as well as the number than what we had yesterday. And then we see Ethereum is still in the red. Remember that observation yesterday, some expectation that Ethereum might go lower than 3,000. Well, it's still above 3,000. We don't know how true that fear or risk is. BNB is in the green at $565.16. Cardano in the green, XRP. At least we have more greens today for this afternoon, Solana and all of that. But let's look at the headlines. Bitcoin having that momentum right there. It's gained slightly after it fall from that 70,000 level. It's up by 0.6% in the last 24 hours. And expecting that it will sustain this at least for now, but we know that all of this is towards that halving, which is just in a couple of weeks. Another headline is the ETF. The ETF net inflows has surged. That's the Bitcoin exchange traded fund inflows. It saw a notable increase, and that's according to Spot On Chain data. I saw about $39 million inflow after that constant inflow of 2 days. And then also concerning Bitcoin, the Bitcoin whales holding skyrocketed by 6,900% amid price dip. So you see investors are also using the opportunity to get on there. And this is according to data from the block's large holders net flow metric revealed this. And delving into the figures, the net flow of Bitcoin into the wallets of these large holders witnessed a remarkable turnaround from the 1st of April. Now let's get some flesh to all of these numbers with Olumide Adesina. Hi, Olumide. Good afternoon.
Yeah, good afternoon. Thanks for having me.
Good to have you. So we see Bitcoin is in the news everywhere, from the ETF to the Bitcoin whales holdings and all of that. This is moving towards the halving, I guess.
Yeah, I think Bitcoin had a good Q1, just like you rightly reiterated. We saw inflows from ETFs, traditional investors at levels not seen in the space, and we saw market elevation hitting above the $2.5 trillion dollar mark. But having said that, we're seeing that there's been moderation in the start of April, despite the season of halving. And you know, usually halving, one of the pictures it brings is that it makes the world for Bitcoin harder and scarcity increases. But you know, excitement along the space with the likes of Solana, which has brought in meme coins, you know, trendy meme coins, that has somehow taken the shine of Bitcoin halving. But having said that, I think why we saw moderation in the first couple of days is partly because there are valid reports that the United States government is trying to sell some of their Bitcoin stash valued at about $2 billion. You know, if you recall that they seized some of this stash during the Silk Road investigation, and it seems appropriate now the government might want to sell at profit. So that's some of the macros weighing on the market. But this I forget, Goldman Sachs also brought in a negative outlook about the market, that there are wealthy clients manage because they manage sizable amount of wealthy clients in America, and they're saying that, well, from what they're saying right now, it seems that investors are really not interested in the asset. So we are seeing mixed outlook and mixed macros, despite the 65% year-to-date return we saw in Bitcoin in Q1.
So at this rate now, I'm just curious. We've had a lot of projections. Bitcoin is going to hit $100,000, $150,000, and at what point do we expect these numbers to actually come to pass?
Well, it's one of the toughest thing in the market is playing the role of God, market prophecy. But, when you look at prevailing situation, the Israel-Gaza, the Ukraine-Russia, and the fact that gold is eating records after records, it seems to be when. And that's really a very difficult question because it seems the US Fed is not really going in line with bookmakers. Earlier this year, we believe that Fed cuts would really be amplified. But with the economy of the United States looking very solid despite high interest rate, the Fed seems to be hesitant. So that has affected risky assets like the crypto market. So back to your question, Standard Chartered said at some point that the crypto asset would hit over $100,000. But for me, I think in Q2, it would be lucky to stay above the 70 rally, and that's because the dollar is really roaring.
And you think the halving cannot help the situation?
Halving will definitely help the situation, but what has really helped in Q1 was ETFs inflows, just like you rightly reiterated. And despite halving coming in play, it's not going to be immediate. So I think the gains of halving will come later in Q2 and early Q3.
All right. But in all of this, what's happening to the alts? I started this conversation yesterday, but I couldn't finish it up. I mean, because sometimes we just get so carried away with what's going on with Bitcoin, we forget about the alts.
Yeah, I think Solana has taken the face of alts this year. You look at the fact that on DEX trading volumes, Solana has really outpaced Ethereum and BNB, and that was pretty much in sustainability around that space, despite its exposure to FTX. One would really say mimic coins as a corporate, and that we've seen among trading Nigerians and traders. So despite the fact that we've seen Bitcoin really rally, I think Nigerians are more interested in the mimic coin phase, and that's why you see activity around the Solana space going up. But on the crypto industry, I think one thing we need to also look at is that investment in that quarter by venture capital increased by over $1 billion in crypto projects, despite concerns that the economy is tightening. And we saw that the case in Nigeria where the Binance executives were held. There are reports that these entities don't really have managerial roles. So it seems more like a hostage situation.
All right. Thank you so much, Olumide Adesina, for your views this afternoon.
Thank you for having me.
All right, so that's where we draw the curtains on Business Incorporated for the midweek edition. There's another one coming up tomorrow. Don't want to miss it. Remember, you can always watch the program at any time on our YouTube channel. You can watch Business Morning also. Great conversations, and you don't want to miss out of it. I'm Ini John Mekwa. Enjoy the rest of your day.